Autocallables are a type of structured product that have become a popular source of yield in countries with low yields, such as Korea, Japan, and in Europe. These products essentially serve as a replacement for bonds in such areas, where a yield-like return is created by using a combination of options. Although retail buying of autocallables is typically associated with countries such as South Korea, where the notional volume of autocallables issued can easily get past $50 billion per year, in recent times, the US has now become the larger issuer of autocallables. Although they come in many variations, the reverse convertible is a popular type of autocallable that is linked to the performance of a stock, a combination of stocks, or indices. These reverse convertibles typically pay off a high-yielding coupon if the price of the underlying is above a certain threshold by a certain date, buys the stock at a higher price for a loss if the price is below a certain threshold, or returns the principal if the price stays in between those two thresholds. This essentially creates a payoff structure where the customer profits if the underlying is above a certain threshold, loses if the underlying is below the barrier, or breaks even if the underlying is between those two at a specific date. To achieve this, the structured product normally involves buying a digital call and selling a knock-in put, which is then sold off to the customer. This leaves the bank long the knock-in put and short the digital call. For the purpose of this video, we will focus on the knock-in put component of autocallables. Prior to the introduction of the Volcker rule, banks had more flexibility in their hedging based on their forward outlook and tolerance for risk. However, after this, banks are no longer interested in taking any directional risk, but simply make money from the commissions they get for selling the structured product while hedging their exposures on the knock-in puts and staying neutral on all their exposures. Although there are several exposures to hedge, such as skew, interest rates, and dividends, in this video we will focus specifically on gamma and vega exposures. The difficulty in hedging knock-in puts comes primarily from the non-continuity of its payoff structure at expiration, which creates unique challenges as the price of the underlying approaches the barrier, where sudden jumps and gaps in the payoff structure can occur. When a bank is long a knock-in put, the bank has a P&L profile where they are flat unless the price hits a certain barrier level. Once the barrier is hit, the bank suddenly becomes long an in-the-money put. Thus, knock-in puts are essentially puts that only come into existence once a certain barrier is hit. The price of the knock-in put changes over time, where it starts off as a smooth curve and gradually becomes a steeper curve near the barrier as time passes. When the bank is initially long a knock-in put, they are long gamma, which they must hedge by being long a small amount of forwards of the underlying. This also leaves them long vega, which they must hedge by selling vanilla options, typically puts with strikes between the strike of the knock-in put and the barrier. As long as the price of the underlying does not fall significantly, hedging of the knock-in put is relatively easy. However, as the price of the underlying begins to get closer to the barrier level, hedging becomes increasingly tricky. As described in the previous video, delta hedging gamma exposure involves buying stock in proportion to a line going perpendicular to the slope of the P&L at the current price. This essentially rotates their P&L profile such that the slope of the P&L profile is flat at the current price. If the price of the underlying falls further, the slope of the P&L profile of the knock-in put becomes increasingly steep, which means that the delta can actually go above 1 in certain cases, and means that the bank has to incrementally buy even more of the underlying. Essentially, this means that the bank is forced to provide bids for the underlying over a certain price range that increases as the price of the underlying gets closer to the barrier. Likewise, when hedging vega exposure, the bank is forced to sell more vanilla puts with strikes between the barrier and the strike of the knock-in put. Ideally, the perfect hedge would be selling an option that has the exact vega profile of a knock-in put. However, due to the uncertainty associated around the barrier, this makes the vana of a knock-in put greater than a vanilla put, meaning that the vega changes more as a function of price. Thus, to replicate the vega profile of a knock-in put, this means that as the price of the underlying goes down, the bank must dynamically hedge their vega exposure by incrementally selling more vanilla puts as the price approaches the barrier. This has the effect of decreasing implied volatility on these puts as the price of the underlying approaches the barrier. On the other side of this is a market maker who must buy these vanilla puts from the bank. Market makers themselves must delta hedge their exposures on these in-the-money puts by being long stock, proportional to the probability that these options go in the money, represented by the blue shaded area. As the price of the underlying falls, the market maker's gamma exposure forces them to buy more of the stock. Since the bank selling puts helps to decrease implied volatility, this helps to decrease implied price distributions, which means that the market maker must delta hedge their Varna exposure by also buying more of the underlying. The combined effect of the bank delta hedging their gamma and selling Vega to a market maker, and the market maker also delta hedging their gamma and Varna exposures, means that on net, banks and market makers are acting to support the price of the underlying by buying more and reducing the implied volatility as the price of the underlying approaches the barrier. However, once the barrier is breached, the order callable ends with the customer having to take delivery of the underlying at a higher price, thus incurring an instant mark-to-market loss for the customer. This means that the bank no longer has a knock-in put and thus has nothing to hedge, leaving them with just their long hedges. Since these hedges are no longer required, banks are now forced to sell them off, which can drive prices down even further. Likewise, the bank no longer has any long Vega exposure from their knock-in put, meaning they are left with their short Vega hedges. These must also be removed by buying back those options and thus driving up implied volatilities. Similarly, the market makers who are on the other side of those vanilla puts no longer have any puts to hedge, meaning that they must remove their underlying hedges by selling it all back. This can also help drive the price of the underlying down even further. And thus, the combined effect of banks and market makers as the price of the underlying falls below the barrier is that they are required to sell the underlying and drive up implied volatilities. When many banks and market makers are simultaneously attempting to get rid of these hedges at once, this can lead to problems in liquidity, which can lead to particularly catastrophic drops in price and spikes in implied volatility. The combination of these hedging activities means that knock-in puts helps to make the markets more brittle or create more leptokurtic price movements. That is, markets become more resistant to drops in price when approaching the barrier due to the incremental buying of the underlying and reduction in implied volatility due to the bank's selling options and buying of the underlying from market makers on the other side of those options. These help to prevent prices from dropping down even further. However, if the barrier does get breached, then these supportive actions are removed all of a sudden, thus exacerbating decreases in price and spikes in implied volatility. As structured products such as reverse convertibles become more popular and widespread across other asset classes, including cryptocurrencies, hedging of banks and market makers near the barriers of these products can begin to have significant effects on the price and implied volatility of underlying. Knowledge of these types of dynamics is thus important for any equity, index, or cryptocurrency that is linked to a large structured product flow and can be taken advantage of by investors.